I'm just trying to get people to stack gold and silver so they don't have to use zombie apocalypse hot sauce to make dead bodies more palatable. Hey guys, Ralph here from the Endgame Investor. And today, what are we going to talk about? We're going to talk about the fact that there was huge physical gold buying in New York yesterday at just below the $4,500 mark. This is the third time it's happened in the last 2 or 3 weeks, which means at these price levels, a lot of physical demand comes in, which is really the bottom line. So I don't think gold prices can go much below this level. I don't know how much longer they're going to hang out here. The other thing we're going to talk about is the fact that I got a new hot sauce for my background. Check this out. Right next to the COVIDiot, so I always remember what happened in 2020 to 2022. This is the Zombie Apocalypse hot sauce, which I plan on never opening unless I have to eat people. But because I stack gold and silver, I don't expect to have to eat people in the end game. But I will be donating the Zombie Apocalypse hot sauce for anyone who has to eat dead bodies on the run.
When the virus struck, for obvious reasons, the first ones to go were the fatties.
I won't actually be doing that, don't worry. But you see, I have the Zombie Apocalypse hot sauce strategically placed next to the COVIDiot because they're basically the same thing. And why am I talking about the COVIDiot now? Well, there was another suicide in my community, unfortunately, recently, and I'm not allowed to say anything about linking it to lockdowns, so I won't, because you can't say things like that. Anyway, I'm kind of pissed off, but anyway, we'll talk about gold and silver, and hopefully I'll cheer up, because the faster the end game comes, the faster people are going to have to work to live, and that will keep their minds off of their own PTSD so they can function like humans instead of dwell on their own pain constantly as the government gives them welfare checks and they don't have to do anything. This video is brought to you by my Substack and also my Patreon, where the next thing we're going to talk about is the new silver standard of Ezekiel. Yeah, I found during end times there's going to be a new silver standard. The shekel is going to be revalued from 20 to 25 relative to gold. So we started at 20 and then we're going to go to 25. Something like that. I mean, it's all in the verses. You'll have to check out the Patreon, check it out in the link in the description below. It's only $3 a month, and I only charge that to keep out the trolls because I don't like those things. Anyway, we're going to go on with the slides and the physical buying in the New York futures market yesterday, and we'll move on from there eventually to New Zealand. Okay, so first of all, the huge physical gold buying yesterday. So we see here, this on the left here is the COMEX delivery reports. So I highlighted when there was a spike in deliveries. You can see here on May 19th and May 20th, 858 and 756 deliveries. That was both more than the day after first notice. Here's first notice. That means when the contract goes to delivery, there's 2,476. We haven't gone above that, but these are two big warrant delivery days for physical gold on May 19th and May 20th. And again, yesterday on May 26th, you could see more than twice that amount, 1,873 deliveries yesterday alone. How did that happen exactly? Well, you can see here in May 2026, this is the COMEX stats for yesterday, May 26th. And we can see that 1,060 new contracts were opened in spot gold in May. It is now May. So that means that whoever was buying this contract expected immediate delivery, or at least 1 day or two delayed. And we see here another thing, and that is that at close, open interest was 355,800 contracts. I'm rounding up by one contract. You can see the actual number here. But we have 2 more days to wind down the June contract before it expires or goes to delivery. We have 63,500 contracts. Once again, I am rounding up by by one contract. I think that's kosher. I think that's okay. What I'm saying here is that there's a lot of physical buying going on at these price levels around 4,500, and I'll prove that in the next slide. What you see here is the gold price, and I have put in black rectangles the candles that have induced the high deliveries. So that's around this 4450 500 zone. You can see here is the low in gold after the crash to about 4100, a little bit below 4100. So we see here that when we get to this level, this line, there's a lot of deliveries that are demanded. So I don't think we can get much below this line because that's when physical buyers come in and say, well, gold is that cheap. I'm going to buy some. Actually, I'm going to get delivery of the contract and I'm going to get the warrants into my account. And if you want to load out, you need $1 million or more in total assets, and you need to use a broker that can do that. I tried to do that and I failed. I'm just trying to get people to stack gold and silver so they don't have to use zombie apocalypse hot sauce to make dead bodies more palatable. Gold open interest to hit still new lows. You saw the open interest number that I showed in this in two slides ago. 355,800 again, rounding up by one. I'm sorry. Uh, so this number, 355,000, I drew a red line where that is. I zoomed in like 800% and I counted by the pixels. So this is a pretty accurate red line here. I'm pretty proud of it. Like if I'm good at anything, it's drawing red lines at places that are accurate relative to open interest in the gold futures market. That should be on my tombstone. I think. 355,000. This is the low that was hit in April. And we're going to get below it. Why? Because there's like 63,000 contracts still open in June gold, which goes to delivery in 2 days.
In 2 days.
2 days?
Those are all going to be cleared out. Some of them are going to be rolled over, but some of them are going to either go to delivery or they're going to be canceled out. They're going to be closed. So I think we're going to hit maybe like 340, 330, maybe even 320, 320,000 contracts before we head back up again. This is an extremely low number. I'm sorry if you heard that. My window just farted. I don't know what to do about that. That's like a structural problem. Anyway, so technically, in the technical sphere, I'm not a big technical trader, but I can see basic patterns here. And the basic pattern that I see here is that gold has been struggling against the 50-day moving average, which is it's a pretty short-term average here. So if we're struggling against this tiny little average, we're not quite in a bear market yet. We're not even close. But anyway, if we can get above the blue line here, which is the 50-day moving average, which is currently at 46.48, and that can happen any day, then that would mean that that would suggest that the current correction is either nearing its end or over. I titled this slide, "The Missing Piece Fiat Money is the Bond Market." Now, what does that mean? What do I mean by that? The bond market is telling us the free lunch is over. This is an article from, I think, Axios. The bond market is telling us the free lunch is over. And you can see here in the picture of the free lunch. What is the free lunch? What is a free lunch? Well, it's just borrowing from the future. You can see here, here's $1 crumpled up. Here's 1,000. I think it's yen. Maybe it's yuan. I don't know. That looks like an Asian looking guy. It's either China or Japan. Maybe Thailand. I'm such a racist. I don't know. I can't really tell the difference between them. Sorry.
It works by detecting light reflected off the skin. It doesn't seem to see black people.
That's more than weird, Veronica. That's basically, well, racist.
And I don't know what that is. This is a fork. I know what you do with a fork. We see here, here's the caption. For most of this century, rich countries have enjoyed a seemingly free lunch. They could spend money as needed, cut taxes at will, and stimulate their way out of problems without paying a price in the form of higher borrowing costs or inflation. The big picture, that era is over. Right? Okay, there's no more free spending. The $145 trillion global bond market is flashing red signals. There's now a price to be paid for governments that indulge their profligate impulses. That's crazy. Why should there be a price to be paid for profligacy? Is it because economics is a study of scarcity and choice? Well, what did I really want to say about this slide? That is, okay, so forget about everything that was written by the idiot who wrote in this Axios piece about interest rates going up. What he doesn't realize is that like 90 to 95% of the money that's in your pocket, and by pocket, I mean actual pocket, or in your bank account, or in your brokerage account, or whatever it is that you think is money other than gold and silver, that's your pocket. All that money that's in your pocket, it's like 95% bonds. Why is that? Because the issuer of the paper, of the digits or whatever they are that you count as money, 95% of that on their balance sheet is debt. It's bonds. That's what it is. So if bonds are going down, don't be surprised when the purchasing power of the money that you have goes down. If this is the top of the bond market, if interest rates are going up, meaning the bond market is going down, the purchasing power of the debt that you own that is owed to the public by local and federal and state, that wasn't in order, governments, the value that's going down. And so the purchasing power of what you think you have is going way, way down.
Way down. Way down.
Now let's go to New Zealand here. The world's most extreme housing boom is now roiling an entire economy. This is from Bloomberg. The slump, it's talking about New Zealand, okay? New Zealand housing prices. So you see here the price of New Zealand housing from 2018, whatever this number is to whatever that number is, it's a lot. And now it went down into 2023, and now it's been stable since it's been stable since 2023. Stable prices. Isn't that a good thing? Apparently not, according to New Zealand or whoever was writing this article. The slump threatens the slump meaning the slump means stable prices. Okay, you should know that that's what they're referring to. The slump is stable. Here's a pretty insane paragraph. This is really insane, and this is why I title it "This is a mental illness." If you look at our history, it says in quotes, we've had various times when prices have been rising or flat, said Bernard Hickey, a longtime New Zealand property commentator. Yeah, Hickey, okay. But we've never had a time like now where prices have been flat or falling for more than 4 years. Actually, they haven't been falling, they've just been flat. 2023 to 2026 is less than 4 years. They've just been flat. Pricing has been stable, and you're comparing that to Armageddon. That's not unusual, he says. It's politically dangerous and toxic. Apparently, stable prices, stable housing prices, or stable prices, anything by extension, is politically dangerous and toxic. That's how retarded our monetary system has become. That when the price of anything becomes stable, it becomes politically dangerous and toxic. Okay, that's the world we're in. I'm sorry. The last slide that I have here in this collection of lovely slides is China. This is actually China. China residential property prices. Do they think that New Zealand is really that bad? China's housing prices have been in decline from 2022 to now. For 4 years, they've been in decline, not stable. They've been decline for 4 years, or a little bit more than 4.5 years. It's already almost June 2026. So this is the beginning of 2022. That's 4.5 years. You can see here's a little 2008 housing decline over here, right? There's these two little bars. Here's the 2012 housing decline. Here's 2014. That was when Macau was crashing. I remember that because I worked for a gambling site called Calvin Air. And now here is the 4-year housing crash of China. It's not, New Zealand is not your poster child here. It's China. China's real estate market is momish crashing. It's really crashing. But here we have this chart, and this is from Fred that I jiggered. The mortgage-backed securities divided by the total balance sheet. So this is the percentage of the Fed's balance sheet, which is comprised of mortgage-backed securities. Mortgage-backed securities is basically the backbone of the entire housing market in the United States and any other place, any other market where mortgage-backed securities are sold. So this is owned by the Federal Reserve, which is the issuer of the dollar itself. So we have about 30%. It's been about that for 6 years. Since 2020, we've had about 30% of the dollar is comprised of mortgage-backed securities. So what do you think happens in an economy where, a global economy where the reserve currency is the dollar and the 30% of the reserve currency's market cap is backed by housing in the United States? That means when housing prices go down, as they are in New Zealand, or at least they're stable in New Zealand, as they are in China, once housing prices start to fall, 30% of the dollar's market cap falls with it because it is mortgage-backed securities. That's the problem. The problem is that the dollar is welded to United States real estate markets. And when one falls, the other falls with it. And what do you have after that? It's going to be good after that. Getting through that's going to be the problem, but everything's going to be okay after that. Not everything, like, most things. In the meantime, hunker down. It's going to be okay. Whoever survives this is going to be part of the leadership of the next generation of humanity. Hope it's not going to be too much of a bottleneck. Have a good day, everyone.
The whole freaking system is out of order. You want the truth? You want the truth? You can't handle the truth!
If the company keeps hiring white people to follow black people, to follow white people, to follow black people, by
Thursday, June 27th,
every person on Earth will be working for us. And we don't have the parking for that.